You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Supreme, Barratt, Baltic, Severn Trent, System1, and our US company of the week is PepsiCo. Sam, do you want to kick us off with Supreme?
Yes, a favourite of the show. I think it might be in the fantasy portfolio as well, actually. If not, it's one that I own, at least, in any case. So Supreme, who are a leading manufacturer, distributor, and brand owner of fast-moving consumer products, which includes a very significant proportion of the business, I think over 50% now, that comes from vaping, with them having over a 30% market share by volume of the UK vaping market. So they have come out with their half-year results, and revenue was up 63% to 105.1 million. Gross profit was up 57% to 28.5 million, and the gross profit margin decreased from 28 to 27%. Adjusted EBITDA was up 88% to 15.2 million, and profit before tax was up 179% to 12.3 million, with adjusted profit before tax up 103% to 11.8 million. Earnings per share was up 182% to 7.9p a share, and adjusted earnings per share was up 80% to 8.1p a share. Net debt was up 36% to 19.8 million, and adjusted net debt was down 63% to 4.8 million. And it's adjusted to exclude IFRS 16 leases. The dividend was up 88% in the year to 1.5p a share, and they've said the Elf Bar distribution opportunity, which generated 26.4 million of revenue in the period, has been reported within branded distribution in the segmental analysis. They've highlighted strong organic growth of 8.7 million from lighting, which grew 21%, vaping, which grew 17%, and sports nutrition and wellness, which grew 17%. And the contribution of prior year acquisitions reported growth of 5.4 million. They've completed the fit out of the Arc warehouse on time and on budget with minimal disruption to the wider business, and that's become the new principal warehousing and distribution centre, which will support both organic and acquisitive growth. They've announced a 25% increase in vaping production capacity of the Manchester-based manufacturing site to accommodate the manufacturing operations of all three vaping businesses acquired in the 2023 financial year and to support further organic growth. They've rolled out and significantly scaled the new Elf Bar distribution opportunity, including new customer onboarding and extensive product testing, which demonstrates the company's ability to adapt quickly to new opportunities. They said the second half of the year has begun very well, with continued growth reported across all divisions within the group. And they now expect trading for the full year to be significantly ahead of the guidance, with revenue guidance of 210 to 225 million and adjusted EBITDA guidance of 32 to 35 million, an increase of around 4.5 million compared to the previous guidance, with around 1.5 million of incremental adjusted EBITDA arriving from the core business and around 3 million from the Elf Bar distribution opportunity. In terms of the valuation, the business trades at a PE ratio of 8.33 and has a dividend yield of 2.63%. As a shareholder, there's not really anything to complain about in here. It's a fantastic set of results. Very, very reasonable valuation still, despite the share price increasing about 60 or 70% this year, I think. And I think the only concern would be the upcoming ban to disposable vapes, but they have said, or previously, they expect the majority of customers to switch to the other products, so non-disposable vapes and e-cigarettes. And I think, if anything, the share price has actually done better since then, because it's at least the announcement of the upcoming ban has removed the uncertainty that was surrounding the stock. So I'm very happy with it. John, what are your thoughts on the results in the business?
I mean, I thought they were a fantastic set of results. I certainly don't think you can knock them. I suppose the difficulty, as you say, and as is reflected in the valuation, is just the political uncertainty. Although I think, as far as I'm aware, Labour had previously said they would just continue essentially proposed legislation that the Conservatives have proposed in respect to banning disposable vape sales and, I suppose, restricting some of the marketing, going down the more plain packaging sort of route. So I don't know. I think, given that it's reflected in the valuation and for the growth industry that it's in, it does look very cheap. And you do wonder in many ways whether it would be an acquisition target just because of its exposure to UK vaping, and whether any of the big tobacco players would be interested in coming and just picking up Supreme, because I'm not sure what the market cap is, but compared with its big listed peers like Imperial Brands and British American, it is a minnow. So I think that's interesting. They do also, I know a lot of the revenue is coming from vaping, but they do also have other brands in there. And I think they've recently acquired, I want to say it's Northumbrian Water, but I think it's a Northeast-based water brand as well. So they've got a broader ranging than just vaping, but I know in recent years it has become much more heavily concentrated on that. So yeah, I think fantastic set of numbers. I know slightly controversial in the area it operates in, and then you've got a very modest valuation, probably reflecting that political uncertainty.
The market cap is about 200 million. So yeah, for someone like British Americans, or even Imperial Brands, which is a lot smaller and has actually struggled to build their own non-combustibles business, this would not be a big acquisition at all.
So if in that context, it was maybe 2014, 2016, something around, 8 to 10 years ago, Imperial paid, I think it was close to $10 billion for Blue, the e-cigarette brand from Reynolds. And then you look at Supreme and what does he say, 200 million? I mean, it's absolutely tiny.
I mean, you could go in and double it and just offer 400 and it would probably be accepted. And it's still tiny for them.
It's still tiny, yeah. So anyway, we'll see what happens with that. But it's an interesting, fast-growing UK business. And I think the other thing to say about it is it's AIM listed. And the founders' family do own the majority of shares. So that's, I suppose, from a corporate governance point of view, that's something that people may or may not like about it.
I would say with the founders' family, so it's the son of the founder that's now running the business. You can't get a full sense, but they do an investor presentation every 6 months, and he is on that. And he does seem pretty transparent. There's nothing overly concerning about the way he deals with stuff or answers questions. And I know he's always going to be on his best behavior on those calls, but I suppose it's probably the best thing you can do is try and get a sense of what you think of him. But I like the way he comes across anyway.
Yeah, and with those figures that he's putting up, and for just over 8 times earnings, it appears pretty cheap.
Yes. So should we move on to Barratt Developments?
Yes. So we cover a lot of the UK house builders, Barratt being the biggest, or certainly when it's being merged with Redrow, it's going to be the biggest. And anyway, Barratt Developments had their trading statement out last week with Barratt's full year average weekly net private reservations rate rising 5.5% to 0.58. And that was helped by the easing mortgage market. And 14,004 new homes were completed last year, which was towards the top end of the group's guidance, but marks a nearly 19% decline in the prior year. Average selling prices slipped from around £320,000 to £307,000, and the order book fell from £2.2 billion to £1.9 billion as of the 30th of June 2024, and net cash fell from £1.1 billion to £0.9 billion, despite a reduction in the land spending. The proposed combination with fellow house builder Redrow for more than £2.5 billion is still subject to regulatory approval. Full-year underlying pre-tax profits are expected to be slightly ahead of the group's previous average expectations, with markets expecting this figure to land at around £360 million. In the new financial year, Barratt expects to complete between 13 and 13,500 new homes, and the shares were down around 2.5% on the statement. In terms of valuation, Barratt trades at 0.84 forward price to book, and its 10-year average is 1.17, and it has a market cap of 4.8 billion and prospective dividend of 3.9%. I think these results were a bit disappointing. Again, it's kind of what we've come to expect. I think the valuation is obviously low by historic standards as well. My take on it would be, given, and I say it every time, but given the structural imbalance in the UK housing market with huge demand, limited supply, and I guess historically, and it still is the case, but huge planning issues, holding up a lot and slowing the whole thing down. You would wonder, with the rhetoric that's come out from the Labour Party and essentially what is now the new Labour government, the large majority, and talk about easing things up from a planning perspective and having, well, greenfield or greyfield sites earmarked for development, whether that really is going to get the house building going at a more rapid rate. My take on it would be that it probably is, and I'd be quite bullish on that. I think that house builders, even though the fundamentals that we've seen haven't changed that much, the sentiment is reflected, and whilst valuations are still low, the share prices have been rallying a bit. Of course, if you're owning a house builders, it's disappointing to see sort of average selling prices slip as well as everything else dipping. Apart from the more positive news of the net private reservation rates rising, I think the trajectory is a positive one overall. And I own Redrow, which is the acquisition is going to be subject to regulatory approval, although it looks like the market's expecting that to go ahead. I would be quite happy holding Barratt or what will be the new sort of Barratt Redrow group, and hopefully enjoying the next few years as we see new homes being built and the planning restrictions easing. So I don't have any major concerns. I think as well, from a macro point of view, and it has been sort of alluded to there with the mortgage rate, one would expect, whilst we're not going back to the ultra low rates that we had since the financial crisis, that as mortgage or interest rates do fall, it is going to be, stimulus to the house builders, and again, that can only be positive for these shares. So I'm quite comfortable holding, and will continue to. I did top up probably about a year ago, something like that. Again, very happy that I did. Sam, what are your thoughts?
I thought the results in comparison to the Berkeley ones we did last week were quite disappointing. I think in the longer term, I wouldn't imagine it's an issue, and there's maybe just a bit of a lag. But the Berkeley results seem much more positive than what we've just seen from Barratt. Whether that's because these are full year results and it's only started to pick up at the tail end, I don't know. But in Berkeley, you could see it in the order book. So yeah, I think it's quite disappointing. But long term, I think they'll sort of rise and fall as a group, so I wouldn't be massively concerned. But yeah, it looks like their outlook for the new year is pretty weak as well. I don't know whether they're just in a different part of the market to Berkeley, but yeah, it's not as good as what we saw last week.
Fine. Shall we move on to a fast-growing company?
Yes, so Baltic Classifieds Group, it's a business we have covered before. For anyone who's not familiar, it's probably easiest to think of them as the Rightmove of the Baltics, as well as the Auto Trader of the Baltics and the Indeed of the Baltics. So they have come out with their full year results, and for the year ended 30 April 2024, revenue was up 19% to 72.1 million, and this is all in euros, by the way, and that was split by a 24% increase to auto revenue to 27.5 million, a 20% increase in real estate revenue to 18 million, and a 17% increase in jobs and services to 13.8 million, plus a 8% increase in generalists to 12.6 million. The EBITDA was up 20% to 55.3 million, and that takes the EBITDA margin up 1% to 77%. And the operating profit was up 32% to 38.3 million, with the adjusted operating profit up 21% to 54.5 million. And that adjustment is for the amortization of acquired intangible assets. So basically, when they've gone and bought, I'm assuming it's brands, but could be something else. But for an intangible asset, it's something like a brand, they get to write off that asset. But that's not actually any cash or anything going out, or they have paid for that brand. But yeah, so the adjusted operating profit is probably a better indicator of how the business is doing, because that will be more in line with the cash position. And the basic earnings per share is up 40% to 6.5 million. We have adjusted basic earnings per share up 20% to 9.2 million. They've highlighted that cash generated from operating activities grew 23% to 59 million, with cash conversion maintained at 99%. They voluntarily repaid 20 million of debt to end the year with a gross loan balance of 50 million, down from 70 million the year before. Net debt reduced to 27.5 million from 45.3 million, with a year-end net debt to EBITDA ratio of 0.5x, which isn't really concerning at all. They've said we maintained our significant leadership position over our nearest competitor across all our largest sites. Autoplius.lt has been at 7x the nearest competitor, up from 6x a year ago. Auto24.ee was 36x, up from 29x a year ago. Arodas.lt was at 17x, down from 21x a year ago. KV.ee plus City24.ee in Estonia was at 19x, up from 16x a year ago. CVBankers.lt was at 7x, down from 9x a year ago, and Scalbury.lt was at 23x, up from 19x a year ago. Traffic to our sites averaged 56 million visits per month, meaning that on average, a resident in the Baltics visited one of our sites 10 times every month. In terms of the valuation, the business trades at a PE ratio of 35 and has a dividend yield of just under 1%. I thought these were fantastic results. It's a business that has been on my watch list since we first covered it, I think sort of a year or so ago. I really, really like the business. It is putting up the numbers. It's done fantastically well, but I just wouldn't be comfortable paying 35 times earnings for it, especially when I don't feel like I have a handle of how big the potential market in the Baltics is, because it's significantly more expensive than Rightmove or Auto Trader in terms of PE. And it might be that there's more of that market still needs to be converted to online, and that's reflected in the share price. But I don't live in the Baltics. I have no way of knowing. If it came down, I'd be really, really interested in this. I'd really like to own this business because I do think it's great, but just not at 35 times earnings. What about you, John?
I mean, it's more or less exactly the same. It looks like a fantastic business. The numbers it's putting up, and yeah, it's got a valuation to go with that. I wouldn't pretend to know about the Baltic market. I guess that is the difficulty here, as well as the valuation. But I feel like if you had a very good insight and you thought that it's not even close to saturation, and maybe you could argue that 35 times earnings is actually reasonable, but it's not an argument that I could convince myself of now with my current knowledge. I'll enjoy watching it. Maybe we'll even have a bit of a look at it for the fantasy portfolio. But I think for my own portfolio, I certainly wouldn't be brave enough and have the knowledge to go ahead with it at the moment.
We move on to a much cheaper business.
Oh yeah, if we have to. So it's Severn Trent. They had a trading statement out with their AGM, and the group reiterated its full year guidance remaining unchanged. The regulated water and waste disposal business expected to deliver between 1.97 and 2.02 billion in turnover, and total dividends for the year are expected to be at £1.06 per share. The group commented in terms of the green power. It's announced that an acquisition of And Digestion Limited, which operates 2 food waste digestion plants, and this is expected to bring an additional 45 gigawatts per annum of energy generation, increasing the green power's output by 16%, although the acquisition is still subject to regulatory approval. And the group self-generated over 50% of its energy consumption, which it notes has acted as a natural hedge for the group, significantly reducing the impact of higher power prices on the shareholder returns. And the shares were broadly flat following the statement. It's, really, really difficult. I would be staying away from all of the water companies. I think politically they are toxic, in this no pun on water quality, but it really, really difficult. And in terms of valuation, it is absolutely reflected in the valuation. Severn Trent has a market cap of just under £8 billion, and it trades at 7.6 times forward earnings. It does have a decent dividend of 4.1%, but I think regulation from these companies is going to be turned right up over the next 5 years, and I don't think anybody has any sympathy whatsoever for the utility groups, and particularly water. They did feature a lot in the Lib Dems and Labour's election campaigns. They need to spend a huge amount of capital. The dividends are likely to become toxic in that, and I think profits are going to be extremely limited in terms of what they're capable and what's politically acceptable to be delivering. So on that basis, I think they're uninvestable. Okay, Severn Trent probably isn't the worst of them, but it's certainly not good and not an industry I would like to be in. Sam, what are your thoughts on Severn Trent?
Yeah, because of the results at that point, it's not actually as cheap as I thought it was. It's not actually that far off Baltic, although I think the quality is very, very different. I just wouldn't touch it for the same reasons you've outlined. I mean, I'm looking at an article here from the end of May, and it said UK water companies were under pressure following a report that Ofwat was set to refuse most companies' requests to hike consumer bills, with some getting as little as half of what they asked for. Now, at the other end of the scale, if you compare that to something like a tobacco company, they are just opposite ends of the scale. I don't want to be in a business that needs permission from a regulator to hike prices, especially in an inflationary environment. I know inflation's now come down, but they're not in control of their own destiny. Now, as a consumer, I'm quite happy they can't just hike prices however they like. But as an investor, I think it does make it uninvestable because, the shareholders are paying for that, really. And as a consumer, I don't have a huge issue with it because the shareholders are there by choice. But I don't know why you choose to hold these shares. I do find it bizarre.
Yeah, and I think also when interest rates are higher, and if you do just want a bond proxy, you can just go out and buy a gilt and get 4% on it. So why the hell would you go near Severn Trent?
Well, yeah, exactly. Because I wouldn't bank on any capital growth from this.
Exactly.
So yeah, you are just buying it for an income, which, like you say, you can get that from gilts. So why take the risk? And there is quite a lot of risk with these businesses, I think, because they're not. I mean, they, like you say, this is one of the better ones. But if we could to look at what's going on with Thames Water, some of them are struggling.
Yeah, absolutely, and no one has the slightest bit of sympathy for them, which is fine. But equally, I wouldn't want to be a shareholder in one of those companies.
No, yeah, there's not really much to get excited about, I don't think.
Fine. So, is this a debut on the show now, Sam? System1?
It is, yes. So it was a request from Paul Adal, who has actually been on the show for an interview. If you want to find that and dig it out, it is very good. But he asked us to cover the results for Systems1, and he said it's a name listing company named after Daniel Kahneman's System1 thinking. It is a marketing platform that has some tech that can predict the effectiveness of adverts before they are placed. They had some interesting results yesterday and have some interesting videos on their site. So if we go onto their About Us page on their website, which is useful, but do take with a pinch of salt because they tend to write positively about themselves when we look at these About Us pages. But they've said our Test Your Ad and Test Your Idea solutions quickly predict the short and long-term commercial potential of ads and ideas, giving marketers confidence that their creative concepts will resonate with consumers and drive profitable commercial growth. With a database of over 100,000 ads, System1 allows brands to compare their ads against competitors. System1's expert guidance helps brands improve the effectiveness of ads and ideas. And in terms of the brands they've worked with, it's a lot of big brands. So they've worked with Pepsi, who we'll be covering later, P&G, ITV, Aldi, Samsung, Mondelez, Amazon, KFC, Subway, Stella. And they've said Test Your Ad is a testing platform for marketers who want to make brilliantly effective ads. Next day predictions, intuitive metrics, and diagnostics you can use. So that on the surface looks fairly interesting. They have come out with their full year results for the year ended 31 March, and platform revenue, which is predicted to improve, is up 43% to 24.8 million. Other revenue, which is bespoke consultancy, is down 13% to 5.2 million. So I did read somewhere that that's basically down by choice because they're focusing their efforts on the predict and improve, which is much more scalable than bespoke consultancy. So in total revenue increased 28% to 30 million. Gross profit increased 32% to 26.1 million, and operating costs increased 24% to 23.4 million. Profit before tax was up 333% to 3.1 million, and profit for the financial year after tax was up 403% to 2 million. Number of clients was up 44% to 428 million. I think that's quite interesting because platform revenue was up 43%. So that kind of suggests they've not really hiked prices at all. They've just done it through getting more clients. Free cash flow was up from negative 3.1 to positive 4 million, and free cash flow as a percentage of adjusted EBITDA swung from negative 196% to positive 92%. Diluted earnings per share were up 404% to 16p, and dividend per share was up to 5p, and that's from not declaring a dividend previously. They had a net revenue retention rate of 100% on platform revenue and significant double-digit revenue growth in the US, UK, and Europe. And the gross margin improved by 2.8 percentage points to 87%. The chairman's statement highlighted that they've worked with 5 of the top 10 advertisers in the US and 7 out of 10 in the UK. And they've said that their top 10 clients made up 30% of revenue and their top 20 clients 45%. All the top 20 clients in the 2024 financial year bought platform products, with 78% of spend from the top 20 clients being on data and data-led consultancy. No one client in the 2024 financial year was larger than 5% of company revenue. And in Outlook, they've said the new financial year has started strongly, particularly in the US, and we anticipate an increase of 50% in Q1 total revenue, with platform fees up 70% versus Q1 2024. We have 3 big opportunities that fill me with belief for the year ahead. Firstly, we're making headway into the US market. Secondly, the relaunch of our Test Your Innovation product will allow us to create a revenue stream for innovation that could eventually become bigger than our comms revenue stream. We say this because according to ESOMAR research, the target addressable market for innovation is 4.8x out of communications at 12 billion. Thirdly, we've not yet maximized revenue opportunities from the world's largest advertisers we already work with. So I think these results on the surface look very, very good. In terms of the valuation, the business trades at a PE ratio of 42, doesn't have a dividend yield, although it has now started to pay a dividend, but that's not going to be huge. It's 5p a share. I think it was on a 740p share price. And yeah, in terms of the share price for the last year, it's just, I think it looks like it's about tripled. It's a fantastic performance and it looks like the business has done really, really well. But I think the time to get it was probably a year ago, because you could have maybe had it at, I appreciate the earnings were lower, but it's one of them tricky ones where if it continues doing what it's doing at 42, it might be quite cheap. And if they're saying revenue is going to grow 70%, that's all going to flow through. They've got all these opportunities in the US. And it does seem like they're working with some very big advertisers already. So this isn't just a bit of a pipe dream. It does look like they've got a very good product based on the client base that they've got. I think it looks like a really, really interesting business. I just think I just wouldn't want to pay 42 times earnings for a business that's tripled in the past 12 months. It probably is a bit of a fad stock at the minute, would be my analysis of it. And I would hope that if you watch it, it might come back down. Now, that being said, if this got cut in half, I'd probably take quite a serious look at it. I do like the business. It looks like the problem is I struggle to know, like we were chatting about this yesterday, John, but in terms of AI, it's like a bit of a buzzword at the minute. If you have, it's sort of bordering on that where, saying it predicts how the ads are going to do. I don't know whether that, how good that is. Maybe it's just a very good piece of software, but I struggle to sort of understand the products. Now, if it's cheap enough, I'm quite happy to take a risk on it. But at 42 times earnings, it's not cheap enough for me to take a risk on something like that. That said, it looks like potentially a very, very good business. And I have added it to my watch list after having had a look. So I would like to come back and look at it in 6 or 12 months and get to understand it a bit more. And hopefully the valuation might have changed. But yeah, it looks like a very interesting business, but also a very expensive one. What about you, John?
I'd feel similar about it. I think it looks like, on the surface of it, it looks like a fantastic business. Obviously, that has been recognised. It's put up some spectacular numbers. And now you're seeing the valuation reflecting that. I probably don't have the risk appetite for it at the moment, but again, following it, seeing it as it matures, and even if some of that really high growth is tempered in the future, if the valuation comes down and it's proving its durability and that it can sort of continue to grow more moderately, that's probably the time for me, even if huge gains might be now associated with that uncertainty and that risk. I think I'd be more comfortable just following it on the show and seeing how we go. And then maybe it'll take the first dip on the fantasy portfolio. And then before my own, I don't know whether I'll be brave enough to commit before then.
But it depends on the price, doesn't it? Because you've got to be a lot braver at 40 times earnings. And if it hadn't gone up at all in the past year and we're covering these results and it was at 15 times earnings or 10 times earnings, it's probably worth a punt at that point.
Well, absolutely.
Probably like Supreme when I bought that. That's done fantastically well, and that's remained at 8 or 9 times earnings. Whereas this one's done fantastically well, and you've had the multiple increase. But shall we move on to one of System 1's clients then?
Yes, absolutely. So we have covered them quite a few times on the show before. It is, of course, our US company of the week, which is PepsiCo. I think we both like it a lot. Often it does just come down to valuation, but an incredibly high quality consumer goods company, and one that you'd rank right up there with Coca-Cola. And it's debatable which one it would be our preference, I think that'd be fair to say. Anyway, they had their Q2 results out last week, with Pepsi's revenue growing by 1.9% on an organic basis, reaching $22.5 billion in the second quarter, ignoring the effect of exchange rates. Growth was driven by higher prices as drink volumes remained flat and food volumes declined by 2%. Quaker Foods saw the biggest decline, with volumes down 17%. Underlying operating profit rose by 7% to $4.1 billion, and higher prices and productivity savings helped improve profitability. Free cash flow worsened from an inflow of $600 million to an outflow of $300 million due to lower cash generation and higher levels of reinvestment in the business. Net debt rose from $34.1 billion to $38.3 billion since the last year end. Full-year organic revenue growth expectations have been downgraded from at least 4% to just 4%, and earnings per share guidance of at least $8.15 remains unchanged. And the shares were down around 2% in pre-market trading. Coming to valuation then, PepsiCo has a market cap of $210 billion and trades at forward price to earnings ratio of 19.3, compared with a 10-year average of 21.8, and has a prospective dividend yield of 3.4%. I thought these results were really quite disappointing. I think when we've covered Coke more recently, they have put decent revenue growth up, and it's been in the higher single digits, and they have managed to maintain volumes as well. I think, in fact, they have managed to raise volumes slightly. So comparing it with a similar business, PepsiCo, it is disappointing to see that. PepsiCo, whether it's a strength or weakness, has the snacks business alongside it, something that Coca-Cola doesn't have. And I would say that still, despite these results, I still think over the longer period and over the last few years, they have set very good results. In terms of valuation, I'd consider these results, it's still pretty expensive at 19.3 times forward earnings. It is below the average. It's a US listed company, and certainly when it's the quality of a business like this, it's never going to come cheap. I don't know where I'd be with it at the moment, because taking the very long-term view, it's somewhat, for the valuation of this particular business, given the quality, it is somewhat attractive, but it still feels expensive. I don't know whether this is the cheapest you are really going to come across PepsiCo, or whether it has further to fall. Very, very difficult to say. So I think disappointing overall, but I do like the business, and I certainly wouldn't be betting against it going forward. But overall, I'd say a slightly disappointing set of results. Sam, your thoughts?
Pretty similar. So I probably prefer Pepsi as a stock to Coke. I think the Coke brand is better than Pepsi. However, I think the most exciting parts of Coke you can get by purchasing the bottlers instead, and like the distributors. So like Coca-Cola FEMSA, which we've covered, or Coca-Cola Hellenic Bottling Company. So I'd probably always prefer them over just Daddy Coke. Also with Pepsi, it does have some really, really good snack brands, and Coke doesn't really have that. That's just mainly drinks. I agree it's probably the cheapest we've seen it, but that's probably just because we're used to sort of covering it in a US market where it's been trading at 25, 30 times earnings, and that isn't normal for a business growing 2% a year. If we were to compare it to European peers, it's still quite expensive. So although you might miss out on it and it might go back up, I think if you wait long enough, you probably will get it cheaper, but you might be talking years. But I don't know. I don't necessarily subscribe to what's in the US, so you just have to accept there's a higher PE because, if you can get Nestle at a cheaper price, which I think at the minute you might be able to, or around the same price, or, Unilever significantly cheaper, similar quality businesses, I think, with similar quality brands, I'd just hang on a little bit longer. I think it's not, if it's 15 times earnings, I think it's a different conversation, but at 19 times earnings for a company that's growing 2% a year, and admittedly, these are quite poor results, although the operating profits fairly decent. But maybe it's going to get back to mid-single digits. This isn't a business that's going to ever be growing 10% a year, probably just because of the size. Although you could argue the market opportunity is there, but that would involve knocking Coca-Cola off its perch, which is much easier said than done. And I'm sure they've tried that multiple times. So yeah, so for me, I'd probably hang on a little bit longer. But that being said, I don't think I'd be interested in it anyway, just given the growth prospects.
Fair enough. So then, of the companies this week, what would be a top pick and what would come last?
I think top pick, probably quite easy this week for me. I think top pick would be Supreme. Fantastic set of results, still incredibly cheap. I do really, really like Baltic, but just the valuation. I think last, it's just very easy. Severn Trent. It's probably the only business of the 6 that we've covered this week that I would consider genuinely uninvestable. Sort of anything in to do with energy or utilities or anything like that, I think is just, they've just got a target on the back at the minute. I don't think that's going to change anytime soon. So yeah, I just wouldn't touch it. What about you?
I would go probably for Barratt. And like I say, for the reasons of being bullish on the housing market at the moment, and it's trading fairly lowly valuation at the moment. I think you've got fantastic results from Baltic, Supreme, System1. So, largely with those, it comes down to valuation on Baltic and on System1. But last, as you say, completely agree. I think it's uninvestable, Severn Trent. So that's an easy last for me.
Very good. I think that's everything in that case.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.